You briefly mentioned there, you're looking at Ethereum. You were weighted 80-20 BTC to Ethereum. And are you expecting that to change in 2021?
Yeah, I'm hoping to add to Ethereum soon. And I will probably continue to add to that, because if I look at the chart of Ethereum versus Bitcoin, it looks like it's basing. Usually, Ethereum is also very much following the 2017 Bitcoin cycle, both in price, in number of wallet addresses, in market cap. I mean, it's identical. It's kind of spooky, which tells you this is being driven by Metcalfe's law and adoption effects than almost anything else. So if that's the case, then we know Ethereum has a decent chance of getting to 20,000, considering right now it's at 11,800. Oh, sorry, 1,180.
Yeah.
I mean, holy shit. That's a value proposition. Even with Bitcoin going to 200,000 to 300,000, one's 8x, one's 16x from here.
Yes. Okay. Now you said hoping to add soon. So walk me through your decision-making process there, if you could.
No decision, it's cash. I'm all in, right? As soon as I get some extra cash, I'll put it in.
Got it. So, okay.
That's how I'm dealing with this is, and I'm hoping I get a dip, but if not, I'll still buy it because I'm not worried about the 50% correction.
Okay.
Just to clear, why am I not worried about the 50% correction? I've got no leverage in the trade.
Yeah.
I know what I can stand to lose.
Yes.
It's not, I'm an all-in, this is my whole life is riding on this. It's not.
Yeah.
This is a very significant bet for me, but taken from a calculated risk perspective.
Quote that I just loved, I believe you tweeted it, was maybe the best strategy for investors, this is not verbatim, is to buy emerging markets and go to the beach. So walk me through that thought process and what does that mean?
So firstly, let me just give you a path. I think there's a correction coming, as we talked about at the beginning. I think it'll hit emerging markets too. The dollar goes up.
Okay.
Emerging markets are going to get smoked.
Everything does, yeah.
Everything does. But in the end of this process, the dollar is either likely to break lower over time. I think it goes higher first, but over time breaks lower. Or my actual hunch is it trades in a sideways range, which is miserable for FX traders, amazing for emerging markets. Stable US dollar is beautiful. So if I look at the chart of the EEM as a simple ETF that you can trade, look at the monthly chart of that, or the underlying MSCI Emerging Markets Index, and it's just a massive wedge pattern. I mean, it's a thing of beauty. And it looks like you've got, most of these emerging market cycles tend to give 400% upsides. That's huge. And that's how it always plays out. So we are almost record undervaluation of emerging markets versus developed markets. We're the largest outperformance of the S&P in history against emerging markets. We are set up for a hell of an opportunity. And if the dollar stabilizes for any period of time and there's some global recovery, which obviously will be coming, these countries have less debts, less aging demographics, less problems, more outperformance. So, and it is generally a 7 to 10 year cycle. So you can buy emerging markets and go to the beach.
And how do you play that market? What are the options available to investors, Raoul?
So how you asset allocate is 3 buckets: liquidity preference, time preference, risk preference. Do you want the thing that's liquid that you can get in and out of when you start the trade, when you don't know it's confirmed?
Okay.
Because you want to be able to get in and out quick, right? You'll do the same in crypto. It's Bitcoin or nothing at that point. Then you start setting your time preference. Okay, I feel like I'm on the trend and I've captured what I think is the start of a larger move. So therefore, I'm willing to hold longer holding periods. So then I might start looking for other areas, or I build a larger position. And let's say EEM is the chosen starting vehicle because it's an ETF, you trade in and out. Then you get into risk preference, the next part of the cycle. When it's established, all investors then start moving out the risk curve. And that usually happens maybe a year or so afterwards, maybe 2 years, where they start thinking, actually, I want to juice this trade. So we see it in crypto markets. It goes to Ethereum, and then it goes to Cardano and other things. And then maybe it's DeFi, right? People move out the risk curve because they think, okay, the trend is set and I can hold a bit more risk than I want. credit investors do the same. They start with single A, they go down to triple Bs, and then they go into junk. The same way in private sector lending. Okay. So the next phase behind that is then choosing which markets do you really want to own. Where could you get alpha above and beyond the EEM? My view for that is India. I think it is the next decade. I mean, I'm half Indian. I spent a lot of time there, and this market, what's going on in India at an infrastructure level, technology level, is mind-blowing. So there is a lot going on there. It's still early. It's like being in China in the 90s. So I'm very interested in that. I'm also interested in the countries that surround India that have young populations and low debts, high household savings. India's at the center. It's basically the Indian Ocean. That is the less investable, which is the Swahili coast of Africa, Kenya, Ethiopia, Kenya, Tanzania, down to South Africa. On the other side, you've got Singapore, Indonesia, Malaysia. On the north, you've got the riskiest but most rewarding market of all is Iran. You've got Dubai, you've got Saudi, you've got Morocco, Egypt. There's a bunch of these countries that have incredible demographics, and some will be long, some will be shorts, but you'll have a lot to play in that sphere. But with India as the core allocation that should outperform.